Unfortunately, I forgot to hit record, and we are actually re-recording this webinar for your benefit. So some of you caught the webinar, which is great, but others sent me an email saying they couldn't make it. They definitely wanted to catch the recording. So here it is. So my name is Naeem Randhawa. I am the host of MuslimWealthClub.com, as well as on our website, as well as on Facebook, Muslim Wealth Club. And I teach people how to start building their online empire. I was a corporate IT guy for many, many years. I worked at places like KPMG and Deloitte. I consulted to Fortune 1000 companies for 15 plus years, places like Walmart, Boeing, Pepsi, FedEx, the state of Texas. I was responsible for online technology solutions and built websites from 100,000 to $30 million for companies like Dell and many others. And about 3 years ago, I left my corporate gig. At the time, I was a VP of big data company here in town in Austin. And I decided to start my own investments into technology and various startups. And recently, I've been focused quite a bit on online e-commerce, specifically with Amazon FBA and other opportunities. And so what I do now is provide value in terms of webinars to help others start on the path of building independence, whether you're currently looking to start a side hustle with your corporate gig, or whether you're looking to exit from your job or business and start something that is new and exciting. The online world in terms of e-commerce, the truly this is the days of really the biggest gold rush in history in terms of business opportunities. I've been very fortunate that I have been able to get into the Amazon FBA business and go from zero to $100,000 in sales in less than 5 months. And so I'm rolling out a course that I'm going to be sharing all this and explaining all of this. And so today, when you do start building wealth, you have to know what to do with your revenue, what to do with your profit, and where do you park your money? Where do you put it in a place that is going to help you grow? Obviously, you don't want to just put it in the bank. And so I've been very fortunate that I was introduced to Sharia portfolio 3, 4 years ago, and I have kept all of my stocks and funds invested with Sharia portfolio. They have served me right. We have been able to beat the market every year. Since the beginning of the year, this past quarter has been just absolutely wacky. I mean, the markets have been upside down. And even though it is I'll say, exciting time, I feel confident that I have the right people managing my hard-earned dollars. And I'm not as fretful and as worried as many others, I think, in terms of the fluctuations of the market. And again, that's having this trusted team that's taking care of my money. So today I want to introduce Ali Rida Walji. He is a investment advisor with Sharia Portfolio. As I mentioned, they are one of the only Islamic investment advisory firms in the country. Ali Rida currently serves as the president of CAMP in Washington. Prior to joining Sharia Portfolio, he worked for 4 years in the mortgage industry at Wells Fargo, and he also volunteers as a treasurer at his local mosque. Ali Rida earned his Bachelor of Science in Biology from the University of Minnesota and his MBA from Crown College. In his spare time, Ali Rida enjoys volunteering and attending various mosque programs and networking events and is an advocate for Muslim unity. He also enjoys cooking, something that I totally cannot relate to, but I will gladly try any dish you want to prepare, Ali Rida, and try it out. And he enjoys spending time with his family. So, what we're going to do over the next 40 minutes or so is we're basically going to walk through what it means to invest in a Sharia compliance manner. What are the options that you have, and the principles that you need to understand. Most of us are laymen, and I include myself in there, And most of us don't really understand the intricacies of investing in a Sharia compliant manner. Um, there are a lot of fluctuations just in the Sharia market itself. What is Sharia? What is not? And so Ali Rida is going to cover some of that with the goal that at the end of this seminar, at the end of this webinar, you have a better understanding and maybe some options to make sure that your hard-earned money is truly Sharia compliant and not not invested in a vehicle that goes against your morals. So we go out of our way to stay away from companies that support certain political and certain agendas, but it is a very, very complex market. And with that said, Ali Rida, I'm going to turn it over to you if you want to go ahead and present your material and turn on your camera. Okay, we can see you now, and your presentation, is that firing up?
Yes, sir.
All right, just please wait while the presenter loads his screen. Okay, so maybe you can just go ahead and get started, and then hopefully the screen will show up in a minute, and we'll take it from there.
I'm going to make sure that the screen is okay. It is being shared. All right. My name is Lira Dawalji, and as you heard, I am an investment advisor at Sharia Portfolio. I am based in the Washington D.C. area, Maryland, and a little bit about Sharia Portfolio and a little bit about me. So I am married with two kids. I'm a family guy. Like to do a lot of activities with with the family. I'm also involved with Camp DC. It's a council for the advancement of Muslim professionals. We have several chapters around the country. In New York, New Jersey, Pennsylvania, and Chicago. And I'm the president of the Camp DC chapter. I have my plate full. Alhamdulillah, trying to keep busy and organize networking events with that platform. But a little bit about Sharia Portfolio. Sharia Portfolio has been around for about, has been doing this, this type of investing for about 14 years. It initially started as a hedge fund about 15 years back when our CEO Naushad Birji was initially investing in industries basically that are ethical in nature from the beginning where industries in the technology, healthcare, utilities, consumer segment, these are the types of industries he was involved in, but he did not really have a complete understanding of Sharia compliance. What does it mean to invest in a halal way and all of that? He was
Hey,
clueless at
Ali
that
Rida,
time. Yes.
I'm sorry to interrupt, but yeah, you're the monitor. Unfortunately, the screen is still not showing up. Can you double check your settings to
Let
see
me
if you're
see.
sharing?
Is it working now?
Yep, now you can go full screen.
All
We
right.
see it. We see. Yep, there you go.
All right. Well, I had not
Perfect.
even started the slides, so you guys did not miss anything. Yeah. So
Good.
at that time when he started out, he was, he wanted to do things in the ethical manner, but he came to learn slowly over time that there is a lot more to it when you want to invest in a Sharia compliant manner, and that's when he launched Sharia Portfolio, and we'll cover what does it mean when you say something is Sharia compliant later in this presentation. So let's get to it. There's going to be four parts in my presentation. The first part is going to talk about the stock market. There's a lot more, a few definitions we'll cover. Some of that you guys may already be familiar with, but nonetheless, for those who may not be familiar with what the stock market is all about, I'll be, throwing out some definitions for you to learn. And then we'll look at value investing. There's different schools of thought when it comes to investing. Our approach at Sharia Portfolio is the value approach to investing. There is technical analysis, quantitative methods, day trading, but we focus on value investing. And then we'll cover, as I said, Sharia compliance. What does it mean when something is halal versus not? And lastly, how to go about investing, in accordance with the Sharia guidelines. So this is a very educational presentation. We do this at a lot of the masjids around the country as well. and hopefully, you can leave with a couple of pieces of information that may be useful for you in your financial journey. So to get started, what is the stock market? The stock market is, a lot of people have all kind of weird imaginations or understanding of the stock market, but on a simple level, a stock is basically part ownership of a business. When you buy, one stock in Apple or one stock in Google or 100 stocks in whatever company, you're basically owning a piece of that company. Whether you're 1% owner or 50% or 100%, you have a piece of the pie essentially. And so that's what the definition of a stock is. Bonds, on the other hand, are loans to a company or government. Bonds are issued to, for example, if the county in your area decides to build a road or a railway line and they need some funding to build that, then they issue what is, bonds, and they give that at a fixed interest rate, and essentially it's something that a lot of companies or governments use to raise capital for their different projects. The other thing is shares. Shares are traded on the stock market. This picture is famous for, a lot of people, if you've watched some of those, CNBC or other movies that have been created about Wall Street, you'll notice this is the kind of picture that is typically that comes up. And essentially, this is the trading floor where people are executing the trades that are received, whether you're buying something, shares in a company, or selling, they're executed at the stock exchange. And positions are held in a portfolio. So a portfolio is essentially a collection of whatever stocks you own. If you own Gentech or Adobe stock or Apple stock or any of these stocks, you're essentially holding those in your portfolio, and those are considered positions that you have in each individual portfolio. So that's on the most basic level that we're looking at the stock market from that perspective. Now I'm going to turn to this chart. This is a chart that, if you look at the bottom, it's from April of 2007 to April of 2009. Now most of you, or most people, when they see this kind of chart, they kind of get fearful. It does not look very exciting. You can see that the numbers are declining over that time period. However, I would like to turn to the next slide, which has the time frame from 1950 to 2015. On this chart, you can see that the trend is upward, and that little figure that we were looking at in the previous slide is that circle that we're, that's highlighted in red. You will notice that, that is more like a speed bump on this trajectory that's, exponentially growing upwards. And what you'll notice is that, we've survived various, things that have happened over time since the Great Depression. We've seen the World War I, World War II. We've seen the tech bubble of 2002, which is the previous bump prior to the one in the red circle. We've seen the financial crisis, which is what you were looking at in the last chart. And despite all of those things, this stock market is still growing tremendously, and the average return is about 10.1%. So this is what people need to be thinking about. In the short term, there can be volatility. You don't have to be scared because of what's going on in the short term. However, if you open your eyes and you keep a more long-term view of the stock market, then you will notice that things are looking more like what's shown in this chart, and the trend is upwards. So why do we want to invest? There are several reasons why people may choose to invest. And I thank Brother Naeem for allowing me to put a picture of his house and car up, as these are some of the reasons where building wealth and acquiring things, nothing wrong with that. Islam does not forbid us to have wealth. And so, owning a good car or house, nothing wrong with that. And then that's one of the reasons. However, on a more serious note, the three main reasons that people choose to invest are for retirement, for tax savings, and for education. Retirement is a big one because most people know and if you're not aware, you should know that Social Security may or may not be around when you're at retirement age. Most experts will agree that you'll only make up about 30 to 40% of your income during your retirement years. So everybody has to plan for retirement. We all don't plan to fail, whether it's for an examination or in life in general. We always want to what's best for each of us. However, we just sometimes fail to plan, and that's very true when it comes to retirement planning. A lot of people wait until their 40s before they begin investing, and what you realize is that even 5 years can make a big difference. If you start at 30 versus 35, I was just looking at a chart recently which showed that if for those who started investing about 5,500 a year, which comes to about 500 or so a month, that person who started at 30, if they were to invest up until 65 at about 6% rate of growth, you will have about $640,000 saved up if you started in your 30s. However, if you wait until just 5 years, 35, then you put the same amount of money away, you will notice that your return, by the retirement age, will be about $450,000. So that's essentially a drop of almost 200,000 just by waiting 5 years. And for those who happen to be in our boat, a lot of people are the late starters, and they want to wait until they're 40 in their 40 because they feel like they have a mortgage, they have their kids, they have a wedding, they have this and that, and they don't take advantage of investing in their early years. You will notice that by the time, if you start at 40 and you wait and you invest only for 20 years, you will notice that your return will be down to about $300,000. So almost half of what would happen had you started when you were 30. So that's just something to think about when you invest. The other thing important to note is, we all want what's best for our children. I'm sure all of you believe that education is one of the biggest things you can do for your kids. And I was just reading Money Magazine's last month's issue, January 2015, and they were saying that the sticker price on a four-year college for a private institution is about $176,000, and that's just 4 years of education. A lot of us want to send our kids not just for that 4-year bachelor's level. We want them to go on to the master's or PhD, or go to medical school, or whatever additional schooling after that 4-year level. So you're looking at a lot more than just that 176,000, which is for a 4-year college. If you were to look at state college, it's about half of that, 80,000. And an interesting thing they also mentioned was that for newborns of today, the private schooling, by the time they turn 18, will be about $400,000. So most of us do not think about that. We think scholarships may come, or they'll earn those, but that's all well and good. But will that really cover the entire cost of college? So we have to plan for education as well. And lastly, there's a tax savings, is a big incentive, regardless of what's happening in the stock market. And I'll give you one example that can illustrate this point. We have one of our clients who's a physician, self-employed, and he was fearful about the stock market, like most people, and was concerned about the volatility. But we recommended, since he didn't have any retirement plans, to open a SEP IRA. And in that, he was able to put away $52,000, and he noticed that his tax bill would go down to $20,000, for that year. So he was, avoiding about $20,000 in taxes, and essentially he's paying himself by putting that $52,000 in a tax-deferred account, that SEP IRA. He's essentially saving for himself, and that's a lot of financial people will recommend that you should save for yourself. At least 10% of your income should, if you can, should go towards your retirement. And that's just one thing. And that even without the stock market making any return, you're still saving that 20,000, and hopefully you'll be able to see that you are able to make returns as you saw in the last chart, from 1950 to 2015. You do see that the return is about 10.1%. And this slide here does actually illustrate that same point, that in a tax deferred account, stocks, the dark blue bar, makes about 10.1%. And this is, by the way, is by Morningstar, so it's not something we're cooking and presenting to you. It's something that they've done the analysis and are showing what you should expect when you invest in the stock market. And if you do not take advantage of the deferment and the light blue bar is showing that taxes basically erode your earnings by about 2% every year. So you should definitely take advantage of the tax deferment, because inflation alone, as you can see, the last bar is about 3%. So you will, if you don't invest, you're essentially losing out on inflation and time. And so investing in the stock market is definitely something to get excited about. On this is one of my favorite charts, by the way. You'll be seeing on this chart, the left is where you're in your youthful years, you're in your 20s, 30s, someone like myself, where your primary job is making up about 90% of your income. And in the beginning, you have a very small percentage in a stock portfolio or other forms of investments. And we'll cover other in one of our next slides here. And on the right is what essentially is an ideal situation that we hope that people should be striving towards. Because number one, you should be we always recommend that people should have multiple revenue streams. Your primary job, stock portfolio, gives you the advantage of liquidity, and as I mentioned, tax savings is a big one. And then other investment, like I said, I'll look at that in a bit. But in the next slide, in the next side of this slide, the right side, you'll see that the primary income that was driving the majority of your income during your youthful years is only making up a small portion, and it has now been compensated by the stocks and other. And as I mentioned, Social Security may or may not be around when you're retired. So if you have planned for your retirement well, then you will notice that the stocks and other investments will be making up for the shortfall, that 60% that I was mentioning. And your primary job is still there. And why I'm showing this is that you're basically, most people do not just want to sit around in their retirement years. They still want to do something. And so that's what that 20% is. You're basically working because you want to, but not because you have to. Now, what are some other investments you can consider? Real estate is one great way to diversify your portfolio, your earnings. We have all heard that you should have a diversified portfolio in the stock market, but that also holds true for having diversification in terms of revenue streams. And so real estate is one great way to consider. Commodities, for example, silver, gold are are other ways that you can build some other investments on the side. We have one client of ours who loves to do photography, and he was taking photos for people free of charge, and we actually recommend why don't you start a business on the side and make some earnings. And he's noticed that he's actually making some decent amount of money on the side just by photography that he's doing. Naeem mentioned he's done several businesses. He worked in the Fortune 500 world, and now he's launching different companies and doing businesses on the side. And I'm sure he's trying different things, and he'll definitely tell you that you should all strive to have multiple revenue streams, because that is important. And then currencies, art, these are all other things. So just look for what you're passionate about and go for it. Part 2 of our presentation covers value investing. As I mentioned earlier, there are different schools of thought when it comes to investing. Our approach is to consider the value approach to investing. And I'll start with the definition for what value investing is all about. This is provided by Benjamin Graham. Benjamin Graham is considered the father or the giant in value investing. He's the one that founded this whole school of thought. And Warren Buffett is actually a big advocate for some of his success to Benjamin Graham. He actually learned a lot of about investing from this person. And he basically says that any investment is an operation is which, upon a thorough analysis, promises safety of principal and satisfactory return. Operations not meeting these requirements are speculative. So what this is essentially saying is you have to do an analysis. You can't just willy-nilly put your money out there and hope something happens. You have to make sure that this safety, the investments you're doing are sound, they make sense, and you're hopefully planning to make a return. Everybody wants to grow their portfolio, so you're planning to have a satisfactory return. And if you're not essentially planning that, or if you're not thinking about where you're putting your money, then you're most likely speculating, which is essentially gambling, and we don't want to be in that situation. So what is value investing all about? Value investing is essentially doing a fundamental analysis on a company you want to look at different things about the company before you choose to invest in that. And I'll give you a simple example. If I was to tell you Sharia portfolio is for sale today, and all of you listening to this can write us a check for $10 million and this whole company is yours, probably, none of you will be interested in doing that until you've asked about 100 or so questions, like, what is the management like? What have your revenues looked like for the past 10 years? Who are your competitors? How, what are the future earnings looking like? You'll want to know all of those things before you invest in that company. And so essentially, it's buying into a business is what you're considering. So when you're buying a stock, like I said at the beginning, you're buying part ownership in a business. And if you're not asking those questions from the beginning, then you're not doing your homework. And you should be. So that's essentially what value investor does is analyze, the PE ratios, the financial standing of the company, among other things, before choosing to invest in any specific company. Next, we're going to look at the difference between value of a business versus perception of the value. Because if I was to tell you this laptop that I'm using to stream our webinar, goes for about $3,000, and let's assume it was generating me income every year about $10 a share, $10 every year magically appeared, and if I was to ask you, what would be the fair value of this laptop, you might say, about 3,000, and maybe 1 or 2 years worth of earnings might be a fair price for this laptop, because something else might come up in the future that would be more reasonable to buy if this is too pricey. So essentially, you're looking at that as a true value. Now, not necessarily, people do not necessarily apply that in their investment choices. And I'll give you a good example of this. In the 2000s, when the stocks of a lot of the tech companies, were trading at, instead of the 3,000 example for the laptop, the tech companies, the share price would be like 50,000. Would you guys get excited about buying, 50 or $100,000 was essentially the price of some of the tech companies, when essentially their prices should have been in the 3,000 range? That seemed ridiculous. And essentially people were buying, and it was not even, that 10 or 50 or $100 every year that was magically appearing was not even happening. So it was a very bad decision on a lot of people's part to put their money into those forms of investments. At that time, we kind of went into toll brothers or building manufacturing companies, and that worked out really well. So and they were trading at a very low ratio. The price to earnings ratio was very low, and it made sense to invest in that industry versus the technology industry. So things may seem exciting, but they may not be the true value of a business. And I'll give you another example of this. Apple computers, for example. We all, like I said, I'm using a Mac to stream here today. We own Apple products, iPhones, and the such. In 2007, Apple decided to release the iPhone, and everybody was excited about it because we wanted to ditch our flip phones, or the Palms, and all of those were very popular, and before that. And we thought this is revolutionary. We all should own an iPhone, but we felt that the price of the company did not justify the us getting into it at that time. So at $250 a share, everybody was calling us and saying, "Can I have a piece of Apple? Please buy this for us." All our clients were calling us, and we recommended against it. But they did. People wanted to do what they wanted to do. 18 months down the line, that same company had a stock price of $80 a share. Now, we felt this is an exciting time to get in, and at that time we called all of those clients who called us in the 2007, and we asked them, this is on sale essentially. Why don't you buy it now? And we would think that they would want to get in and buy even more because it's on sale. And unfortunately, none of them decided to buy at that time. Fair enough, 18 months later, the stock price is now trading at $350 a share. So for those who bought it at the lower price, were now made a good margin of 4 times the return, which to me that's a great return. The point basically for that is that there's a difference between the value of the company and the perception of value. 18 months down, the iPad was coming out, the iPhone was in the 2nd or 3rd generation, and Apple was doing really well as a company, but the stock price was not justifying that in the beginning, and we wanted to make sure that when you buy into it, you're doing your homework and you're buying into it when the price makes sense. And that's essentially what our view is of the stock market. Our stock market is driven basically by buying and selling. We feel that it's manic depressive, where people may be in a happy mood today and they decide to buy a bunch of shares of a company, and the stock price goes up. And essentially, when they're not feeling like depressed, or they're feeling depressed, or they're not in a good mood, and they decide to sell that, and the stock price goes down. And that's essentially what our view is of the stock market. It's the volume that basically determines the price, and not necessarily what's going on with the company. Here is an interesting guy. We all know him, Warren Buffett. He's one of the most successful investors of our time. And his view is that we should be greedy and careful. This does not by any means mean that we're advocating for greed. All we're saying is that you should be looking for the good deal. All of us should be getting excited when it's Thanksgiving, and that's essentially what 2008 was for us. It was the time to go shopping, like Thanksgiving, and we were excited about stocks at that time. We were buying low when the price was down, and each of those companies that we invested in made a return of about 50%. That's a big return, at that time. And instead, most people were running away and being afraid. And basically, Warren Buffett, if you want to sound advice for somebody who has been in the markets and who has understood them for several decades, he says, be fearful, or buy low and sell high. That's essentially what the value investing is all about. The next stage of our presentation is going to look at Sharia compliance. Sharia compliance is going to look at it from two different parts. Number one is what is halal investing all about? It's a definition that has been provided to us by AOFI, and I'll talk about AOFI in the next slide. But basically, they say that halal investing refers to investments made in securities which conform to Islamic principles. When these investments adhere to the guidelines of a trustworthy Sharia advisory board, they are considered to be Sharia compliant. So this is not what Sharia portfolio says is what is considered Sharia compliant. We're actually following what the scholars and the experts in this field are saying, and essentially we should be appreciative of their efforts when it comes to providing us with the guidelines. And what does AOFI stand for? AOFI is Accounting and Auditing Organization for Islamic Financial Institutions. It's a Shura Council of Sharia scholars from around the world. The headquarters are in Bahrain, but as you can see from this list, the scholars are from around the world. And so there's diversity of opinion, and they've all come together to make our lives easier. They're considered the gold standard for investing. They're among the strictest guidelines that we know of when it comes to halal investing, and that is why we chose to follow their guidelines for our investments. This is one field. This slide is going to illustrate what are some of the non-compliant industries that we want to avoid. Now, if I were to ask those who are listening in to this webinar, they will attest to the fact that they don't want to be associated with this. And there's an interesting statistic that says 80% of Muslims want to avoid the alcohol and the gambling and the adult entertainment, and these kind of industries, but less than 20% apply that in their investment choices. And so we're hoping that to educate people that there are alternatives, and you can avoid these industries. And so this is why we're here to show you how we can do that. And what are the guidelines that AOFI provides for this? They basically say that only stocks, mutual funds, and Islamic ETFs are eligible for Sharia consideration in the stock market, basically. Preferred shares are considered to be non-compliant. They are basically a hybrid, fixed income hybrid, kind of like the bonds that have a fixed stream, an interest element to it, and that's why they're not considered Sharia compliant. On this slide is basically the nitty-gritty of what the ratios are when it comes to consideration for Sharia compliance. So basically, the first one says that interest-bearing debt over the net worth of the company should be less than 30%. So if it's a $100 million company, only about 30 million can be in debt. And you'll be surprised. It makes sense that a company should not be in too much debt. We've all seen what the 2008 crisis did. It brought down all the financial markets, and the crux of the issue was debt. And surprisingly, out of 17,000 stocks or so that are out there, only about 1,000 are passing just this first criteria alone. So that goes to say that this is a big deal. When it comes to investing, you want to make sure that the companies you're investing in have a strong foundation. They are based in equity and not debt. The second criteria looks at the cash equivalents over the market cap. So overall, the overall net worth of the company, the cash holdings should be less than 30%. And the main reason is that if they're holding too much cash, it shows that they're kind of straying away from their primary business, which means there's some kind of interest involved. They're probably putting that into some kind of fixed income earnings that they're getting on the side, and that's why that's not allowed. The third thing is that the cash equivalents and receivables over the assets of the company should be less than 30%. Now, a lot of people ask, why is this? Why is this a big deal, basically? And if a company has too many receivables, accounts receivables, then what you'll notice is that they're financing basically to get this, the sale of their products basically. And one example of this is the car dealers that are out there. A car, buying or selling a car, nothing wrong with that. If you go to GM or Ford and you want to buy a car, well, that's a whole activity. However, how do they sell you the car? They finance the sale of the car, and so that's what makes it not Sharia compliant. So they may not have too much debt, but they're putting others into debt, and that's what the third criteria is all about. Lastly, on the financial issues, is the cumulative revenue from the non-compliant activities should not exceed 5%. So a good example of this is like the airline industry. Airline industry, the primary source of income or revenue is generating tickets, is by selling tickets. However, we all know when you fly in any of those airlines, there is serving of alcohol, and so there is some income that comes from that source. And then the Sharia guidelines say as long as that income from that non-halal activity is less than 5% of their overall income, then that's okay. Now, some people may ask, now why is that even allowed, that 5%? And one hadith that's typical is the one where the Prophet ﷺ was asked about a tub of water, that some kind of najis or impurity that entered that, and he was asked, can we do wudu with this water? And his response was yes, because it had not changed the entire structure, or the whole body of water should not be wasted just because of a little bit of impurity. And that's just one of the hadith that the Sharia scholars have come up with. So like I said, we should be appreciative that they've strived hard for several years to come up with these ratios and these guidelines for us to make our jobs easier for those who are living in this part of the world. Lastly, we're going to look at what are the different ways you can go about investing in the halal way. The first option is, you can self-manage, open a brokerage account where you can buy and sell securities on your own. You can have an E-Trade or a Scottrade account, and you can just go ahead and buy some of the stocks that are, by yourself. If you do choose to go with this approach, you'll have to understand when is a good time to buy, when is a good time to sell. You'll have to know whatever investments you're having in your portfolio are aligned with your financial goals. You'll also have to make sure that things are Sharia compliant. So that's basically how, that's basically if you choose to do it by yourself. And if you want to know what is Sharia compliant, look at the prospectus of some of the mutual funds in the Sharia space, and they'll give you a list of stocks, and you can go ahead and buy those by yourself. The other option that you have when it comes to investing in the Sharia compliant way is to buy Sharia compliant mutual funds. There are 7 or 8 or so Sharia compliant funds that are out there, and you can definitely buy those. And when you do buy a mutual fund, what you're doing is you're essentially buying a product. It's a pre-packaged product. A mutual fund typically has about an average of about 142 stocks in them, and nothing wrong with that. But you can definitely buy that, and it's a general fund. One thing to note is that it's a one-size-fits-all approach. So, for example, if I wanted to buy a certain halal fund that's out there, and I also wanted them to include a certain stock that's my favorite stock, and I would like to have that included, where you're out of luck because those companies, they want to create the fund to align with their objectives and may not necessarily be concerned about you specifically. And so that's what happens when you choose to buy with a mutual fund. It's basically a one size fits all approach. The other option that you have in the Sharia space is to work with a financial advisor. A professional advisor looks at it from a very customized approach, where they are looking at, you know, your financial goals, your risk tolerance, your investment preferences, the time frame that you're looking to achieve. It's kind of like if I was to tell you, you're a bit. If I'm overweight and I want to lose some weight, well, I have two options to go about doing that. Either I can go to the gym and work out and try and eat healthy, or I can work with a personal trainer, a nutritionist who can give me the advice on what are the right types of foods to eat, what are the right forms of exercise that I can do, and hopefully I can get to my goals faster, and I can. It doesn't mean you can do it by yourself, as you saw in the previous slides. It just means that the advisor is looking at all of these different factors when they are making recommendations for you. Um, and when you do choose to work with an advisor, what are the things to look out for? And you know, investment philosophy is a big one. I have talked about our approach at Sharia Portfolio is to focus on the value approach to investing. If that makes sense to you, then by all means, work with someone who understands your personal, understands your investment style. It's compatible with you. If you do believe that buying low, sell high is actually the right way to do it, then go with someone, because it's your life savings at the end of the day. You don't want to give it to, you have no clue how you're going to manage that money. So you better be sure about what their approach to investing is and how they're going to put your money that you have your hard-earned money over several years. How are they going to manage that's one big consideration. The other thing is the fee only. Our industry is filled with a lot of salespeople or people who may not necessarily be looking out for your best interest. The advisor is highly recommended, and that's not just what we believe in. A lot of financial gurus, talk show host representatives like Susie Orman or Dave Ramsey advocate for working with fee-only advisors, because when you work with someone who is fee-only, they're essentially a fiduciary. They're looking out for your best interest. The only way that Sharia Portfolio or someone who is fee-only earns their income is if your portfolio grows. They basically charge a flat management fee for whatever assets they're managing, and if your portfolio does well, then guess what? The revenue for the firm does well that's managing that. And if your portfolio goes down, then that also hurts our revenue. And we feel that's fair way of doing business. And the last thing is that compliance. If you do believe that you want to avoid all those different industries and you want to invest in accordance with your personal values, then by all means, work with a professional who understands those things and can create a portfolio that avoids those things. And I'll give you one example. It's like I said, Sharia compliance is a very fluid and dynamic thing. One company that we all may be aware of is Medtronic. Medtronic makes pacemakers, defibrillators, and other heart equipment. And that's a really good company from the standpoint of what it does for humanity. We all understand the need for those type of products. However, when they wanted to acquire a competitor, they needed capital, and so for that reason, they decided to they got into debt, and the debt situation exceeded the guidelines set forth by AOFI and Sharia guidelines. So we had to sell that company because it was no longer Sharia compliant. We made a good return on it, about 40%. However, the point I'm trying to make is that things may be compliant today, but may not necessarily be compliant tomorrow. And in all of your investments out there, whether in your 401ks or IRAs, or college savings, 529 plans. By the way, a lot of people ask me this question. 529 plans are not Sharia compliant because you have pre-selected funds to choose from for the education savings. However, there are other alternatives that you can consider to invest for your kids' education, and we'll be happy to discuss that with you. And with that, I leave you our last slide that has our information. ShariaPortfolio.com is our website. I would highly encourage each of you to visit that. There's the FAQ section and About section, which has some great information that hopefully you can all benefit from. That is a number you can also call 888 Halal Stocks, and that email address as well is available in case you need to reach out to any of us with any of your questions. We will be happy to answer those for you. With that, if you have any questions, like I said, just feel free to reach out, give us a call, you can send us an email, and we'll be happy to discuss any of your goals with that. With that, I thank you for all for listening.
Thank you very much, Ali Rida. That was a lot of material, a lot of good material. And let me do this here. Yeah, that was a lot of great material, which we did record, and we're going to have this available as a recording afterwards for anybody that wants to dive in. And of course, you've got the contact information for Sharia Portfolio. So, a couple things just to wrap up. There has been many surveys that have been done, and the Muslim community tends to be higher educated, earn more than many other demographics within the US. And that presents opportunities. That presents us with capital and with savings. And how we manage that and what we do with that is critical. Obviously, everybody works really hard for their money, and you want to make sure that your money is working for you. So, as I mentioned earlier, I've been very fortunate. I've been a customer of Sharia Portfolio. I'm not an agent. I don't get any commissions or anything like that. So, however, I feel pretty good that my money is in good hands. And because I feel pretty strongly about them, I'm happy to drop their name and recommend them. We have been going through a lot of volatility in terms of the stock market this year. So if you've been following that, you've probably skipped a heartbeat here and there with China, with the oil prices, with the elections. There's just so much going on. However, at the end of the day, I feel pretty good that my money is being handled in the best way possible. We beat the market every year, and inshallah, I don't see why we're not going to beat it again this year. So diversity is also really key. That was another point that was brought up. And as you bring your savings home from your job or from your business, it's really important that you utilize that money. And a lot of people just kind of put it in a bank account and forget about it. But that money that is just sitting there is not working for you. That's not really helping you or your family or anybody. That money needs to be working for you. And the stock market is one place. It's not the only place, but it's definitely one place that you should put either your more conservative funds and put them in a mutual fund and let them be, or be more active and put them in stocks. So I play in the real estate market. I play in the stocks and bonds market. I play in startups. I invest in businesses, and that's really the key: is being in a diversified financial portfolio across not just stocks and market, but various investments, so that as one goes down, you're not all your eggs are not in that same basket. All right, thank you very much, Ali Riddell. Great presentation. Appreciate your time. And just a final reminder: please join MuslimWealthClub.com for more great webinars like this. And again, my mission, I've been blessed financially, and my mission is really to show others who are looking to break out of the corporate career path, as I had been, and help people leverage what the amazing opportunities are that are out there in terms of online e-commerce or real estate or whatever it is. I'm involved in a bunch of those, and I'd love to chat with anybody about partnerships and opportunities, how I can help you. That's my way to, inshallah, pay it forward and give back. All right. Thanks again. Take care and happy selling.